Welcome to our recap. The last couple of days have been a roller coaster, proving once again that markets absolutely abhor uncertainty, especially when it comes to geopolitics and the Fed. We've seen a mixed bag for US indices, with Tuesday reflecting cautious investor sentiment due to ongoing international negotiations and a shifting narrative around AI, while Wednesday opened with a more positive tone. On Tuesday, the S&P 500 managed a marginal gain of 0.1%, closing at 6,843.22, after swinging between a 0.5% gain and nearly a 1% loss throughout the day. The Dow Jones Industrial Average also nudged higher by 0.1% to 49,553.19, and the Nasdaq Composite added 0.1% to reach 22,578.38. This quiet finish certainly masked some wild internal sector rotations. Big tech, particularly Alphabet, felt the downside pressure, falling 1.2%. Even NVIDIA, the poster child of the AI boom, swung between being a heavyweight and a strong performer, underscoring the shifting AI narrative from a broad market driver to one demanding selective investment. It seems some investors are finally asking questions about the sustainability of massive AI spending, with worries that AI-powered competitors could disrupt traditional software business models. Wednesday morning saw U.S. stock futures pointing higher, with S&P 500 futures up about 0.5% and Nasdaq 100 futures gaining just over 0.5%. This upward momentum appears to be driven by easing global inflation signals and a hopeful turn in geopolitical tensions.
Geopolitical developments have been a significant factor, with U.S. stocks opening mixed on Tuesday due to rapidly evolving international discussions. Negotiations between the United States and Iran in Geneva concluded relatively quickly, coinciding with reports of the U.S. deploying additional fighter jets in the Middle East, which initially heightened caution. Discussions also continued between the United States, Russia, and Ukraine in Geneva, keeping investors on edge. Historically, while geopolitical events can cause immediate market declines, an average 1.5% drop in the S&P 500 on the day of an event, their effects on U.S. financial markets are often temporary, with many seeing a rebound within a week. This isn't to say we should ignore the U.S. action in Venezuela, or pressure to control Greenland, or the anti-government protests in Iran and a snap election in Japan mentioned recently. These are serious issues, and any government's diplomatic pronouncements should always be taken with a grain of salt, as market impact is the true measure.
Domestically, inflation data continues to be a key driver. January's U.S. Consumer Price Index, CPI, showed continued moderation, rising 2.4% annually, down from 2.7% in December 2025. Core CPI, excluding volatile food and energy, also slipped to 2.5%, marking its lowest reading since March 2021. While the annual trend is cooling, monthly core prices still rose 0.3%, suggesting inflation pressure hasn't fully disappeared. This disinflationary trend, if sustained, could pressure the Federal Reserve to cut rates sooner rather than later. However, Fed Governor Michael Barr stated on Tuesday that interest rates should remain unchanged until clearer evidence emerges that inflation is moving sustainably towards the central bank's 2% target. The market is currently pricing in a 92% likelihood of the Fed holding rates steady at their March meeting. The labor market added 130,000 jobs in January, nearly double expectations and the strongest monthly increase since December 2024. However, the real story here is the revision to 2025 payrolls, which were slashed sharply lower to just 181,000 for the entire year, averaging about 15,000 jobs per month. This suggests the economy was weaker last year than initially reported, casting a shadow on the strength of the current rebound. Unemployment dipped to 4.3% from 4.4%, and labor force participation improved to 62.5%. Retail sales, a critical indicator of consumer health, flatlined at 0%, with discretionary spending in areas like furniture, electronics, and clothing showing declines. This consumer blinking is a significant concern, given that consumer spending drives 70% of economic output. The U.S. economy is showing surprisingly fast growth, with artificial intelligence and related technologies being the primary drivers. Business investment, particularly in AI, is the surprise star, of the current 5-year economic expansion, with core orders for durable goods climbing 0.6% in December, capping the biggest annual increase in business investment in 3 years. AI companies and chipmakers like NVIDIA are pouring hundreds of billions of dollars into this new technology, filtering down and igniting broader investment. This vigorous investment has occurred despite high U.S. tariffs, which some economists believed would dampen spending.
Fiserv jumped 6.89% after reports that activist investor Jana Partners built a stake and engaged management. Activist involvement often signals potential for significant shareholder value creation, and the market clearly likes the idea. Lumentum Holdings gained 6.70% following Mizuho's raised price target and reiterated outperform rating. Analyst upgrades always provide a nice tailwind. Southwest Airlines climbed 6.16% after UBS upgraded the stock to buy with a higher price target, another instance of analyst confidence boosting shares. Tactile Systems Technology Inc. surged 23.53% after reporting strong fourth-quarter earnings and forecasting 2026 revenue between $357 million and $365 million, reflecting an anticipated growth of 8 to 11%. This is despite potential challenges from Medicare's new prior authorization requirements, demonstrating investor confidence in their underlying business. Celanese Corp soared 5.94% despite posting downbeat earnings for the fourth quarter, primarily due to a positive outlook, with first-quarter adjusted earnings expected between 70 cents to 85 cents per share. Sometimes it's all about the forward guidance, not the rearview mirror. Norwegian Cruise Line Holdings surged over 12% following reports that activist investment management built a more than 10% stake in the company. More activist involvement, more market excitement. Zim Integrated Shipping Services jumped over 25% after German shipping giant Hapag-Lloyd agreed to acquire the company for $4.2 billion. A big buyout always gets investors buzzing. Genuine Parts dropped 14.56% after Truist downgraded the stock due to concerns around the auto business and the company's weaker-than-expected Q4 results. The company also plans to split into 2 separate publicly traded companies in early 2027, focusing on auto and industrial parts, which can be a double-edged sword for stock performance. Leidos Holdings declined 8.38% after earnings and providing 2026 revenue guidance of $17.5 billion to $17.9 billion. Guidance misses always sting. General Mills sank 7% after cutting its forecast for underlying profit for 2026, citing uneasy customers grappling with persistent inflation and a weak job market. Consumer staples showing weakness is a concerning signal for broader economic health. Alphabet experienced a 1.2% fall on Tuesday, part of a broader tech sector sentiment shift, as AI disruption fears continue to weigh on software companies. It seems the AI rising tide lifts all boats narrative is facing some serious scrutiny. CrowdStrike tumbled 3.6%, and ServiceNow shed 1.1% on Tuesday, as the software sector continues to be battered by AI disruption fears. Investors are getting discerning about which companies will truly benefit and which might be disrupted.
The bond market saw a mixed picture. U.S. bond yields were near 4.06% ahead of Federal Reserve meeting minutes. The 10-year Treasury yield edged up to 4.05% on Tuesday from 4.04% late Friday and was up further to 4.07% on Wednesday. This upward movement in yields indicates some anticipation of continued Fed hawkishness or strong economic data, despite cooling inflation. Bond markets overall benefited last week from falling yields as inflation eased further, with longer maturity bonds leading returns. The focus remains on policy expectations and government borrowing needs. In the commodity markets, Brent crude oil was steady at $68, with $70 as a key resistance level to watch. WTI crude oil was at $63.41, up 52 cents, with a $65 support level. However, crude oil futures were trading higher in the early New York session on Wednesday by 0.34% to hover around $62.47 per barrel, although other reports indicated WTI crude futures hovering near $62.61 and slipping slightly to $62.28 amid hopes of easing tensions between the U.S. and Iran. Gold spot US dollar rose 0.83% to hover around $4,918.10 per ounce on Wednesday, but had been sharply lower at $4,860 on Tuesday, with $5,000 as a psychological level. Precious metals have seen volatility, at one point surging to new record highs due to geopolitical tensions and speculative flows. Copper was sliding at $5.70, near a $5.50 multi-year low. Aluminium was noted as sensitive, with a $2,400 production floor. Bitcoin was trading 0.1% higher at $68,101.01 per coin on Wednesday. Looking ahead, traders are keenly focused on the release of the Federal Reserve's January FOMC minutes later today, Wednesday, February 18th, which are expected to detail the depth of dissent within the central bank regarding the path of interest rates. Also today, data on housing starts, building permits, and durable goods orders will be published. This confluence of economic data, especially durable goods orders, will provide further insights into business investment trends. The Big Kahuna, the Personal Consumption Expenditures, PCE, index for December, the Fed's preferred inflation gauge, is due out this Friday, February 20th, and will offer critical information about the economy's health and potential future rate decisions. Geopolitical developments, while somewhat stabilizing, remain a volatility factor, so keeping an eye on international headlines is paramount. For the S&P 500, a pivotal support zone sits between 6,880 and 6,900, with psychological support at 6,800. On the upside, resistance is likely around 6,920, and then the all-time high resistance zone of 26,100 to 26,300, though these are more technical levels that could be swiftly influenced by fundamental shifts. The prevailing sentiment is that until more concrete shifts in sentiment or data emerge, markets could remain somewhat range-bound.